The stochastic indicator is one of the most popular technical analysis indicators used by Forex and stock market traders. Once you understand how to correctly use it, the stochastic indicator can be an invaluable tool to help predict momentum changes. Most traders get confused about how to correctly read the stochastic oscillator signals under varying market conditions. You see, you need to apply a specific type of stochastic trading strategy when the market is trending, but you need to read the stochastic indicator very differently under range-bound market conditions. If you misinterpret the market environment, the same stochastic oscillator value can translate into a very different signal. This is where most traders fail. They simply apply the stochastic oscillator in the same manner, regardless of the underlying market condition, and end up losing money as a result. So what is a stochastic oscillator? Stochastic oscillator is a momentum indicator which compares where the price closed relative to the price range over a given time period. The stochastic is displayed as two lines, the main line called K% and the second line called D%, representing a moving average of the K%. Traders use two types of stochastic, the fast stochastic and the slow stochastic. The fast stochastic oscillator is very volatile. Its reaction to market price will generate many signals. In a strong trending market, the fast stochastic isn't able to filter noise and will offer a lot of false signals, which will lead to bad trades. In order to manage the signal in a more efficient way, the slow stochastic oscillator was developed. The slow stochastic oscillator helps to smooth the noise and replaces the K% with the D% line and replaces the D% line with a 3-day moving average of the D%. Slow stochastic oscillator was basically designed to reduce volatility, but in a strong trending market suffers from the same problem as the fast one. It offers many false signals. Stochastic oscillator comes with the standard 5, 3 and 3 settings. Other common settings are 8, 3 and 3 and even 14, 3 and 3. Depending on your trading style, you have to decide how much noise you are willing to accept with the stochastic. Low values for the stochastic oscillator will make the indicator oversensitive. A stochastic with lower settings will offer a lot of signals, but also comes with a lot of market noise. Higher values for the stochastic indicator will make it less sensitive to market noise. This will lead to fewer signals as the indicator is smoothed. If you want a higher number of signals when you trend trade, then lower settings on the stochastic will suit you. If you are a swing trader or a position trader and want to eliminate market noise, then higher settings on the stochastic will help you to do that. A lot of traders look for the perfect settings on the stochastic indicator when they trade the Forex or the stock market. The reality is that there isn't one. You just have to know your trading style. You then have to backtest different settings depending on the market you are trading and the time frame you are analyzing. I prefer to use the stochastic oscillator with 8, 3 and 5 on higher time frames. Now, how to use the stochastic indicator? The most popular method of generating entry signals, but not a smart one, is to consider the stochastic indicator as an overbought and oversold indicator. The majority of trading books teach you that a buy signal occurs when the stochastic moves below 20 level into oversold area and then crosses back above that threshold, and the sell signal occurs when the oscillator moves above the 80 level into overbought area and then crosses below that threshold. Here's the reality. This strategy works only during non-trending conditions and will fail during strong trending phases. During a non-trending market, the stochastic generates some pretty good signals. In a trending market, however, the stochastic oscillator generates a lot of false signals. The misconception of overbought and oversold is one of the biggest problems and faults in trading with stochastic. After many years and a lot of money lost, I've realized that stochastic indicator does not show oversold or overbought prices. It shows momentum. When the stochastic is above 80, it means that the trend is strong, and not that it's overbought and likely to reverse. A high stochastic means that the price is able to close near the top and it keeps pushing higher. A trend where the stochastic stays above 80 for a long time signals that momentum is high and not that you should get ready to short the market. You see this concept on every chart. The price enters an overbought area during a strong trend and stays overbought for a long period. You don't want to be in the position of traders that shorted the market hoping for a reversal. A smarter entry would be on the long side against traders that considered that the price is overbought and incapable of going higher. The second most utilized stochastic oscillator signal is the crossover signal, which happens when the K% line crosses above the D% line and generates a buy signal. On the other hand, when the K% line crosses below the D% line, it generates a sell signal. Once again, these stochastic oscillator crossover signals are reliable during a range-bound market, but these signals tend to become a lot less reliable when the market is in a strong trend. You can still rely on the stochastic oscillator crossover signals as a trend continuation signal. For example, if the market is in an uptrend, you search only for crossover buy signals on the stochastic oscillator, so you're not interested in shorting the market. You simply want to ride the trend by taking buy crossovers. Similarly, if you see a crossover sell signal during a downtrend, you can also rely on the signal as supporting evidence that the downtrend is likely to continue, ignoring buy opportunities. Maybe the most elegant approach is to look for price oscillator divergences. A divergence occurs when the price action differs from the action of the stochastic indicator. In other words, the market momentum isn't reflected in the price, which could be an early indicator of a reversal. A classic divergence occurs when the price forms a lower low, while the stochastic forms a higher low, indicating a possible buy, or when the price forms a higher high, while the oscillator forms a lower high, indicating a possible sell. When a divergence occurs, a potential change in price direction could be on the cards. This is my favorite method to trade with the stochastic oscillator. I determine the main trend with a 200 period exponential moving average, and I only trade classic divergences in the direction of the main trend, so I ignore the divergences that occur on the pullbacks or corrections of the main trend. Basically, when the price is above the 200 EMA, I search for divergences on the lower side of the stochastic, and when it's below the 200 EMA, I look at the upper side of the indicator. Also, I only trade on the 4-hour and on the daily timeframes in order to reduce market noise and filter the bad signals occurring on shorter timeframes. The stochastic oscillator is an excellent tool for spotting hidden divergences. If you are a trend trader, hidden divergences should be one of your most important tools. Hidden divergences signal momentum coming into the main trend, suggesting a possible continuation in the main direction of the trend. For some reason, hidden divergences are harder to spot by many traders, despite the fact that represent a high probability pattern. When trading hidden divergences with a stochastic oscillator, you have to look for higher lows of the price but lower stochastic values during an uptrend, and lower highs of the price and higher stochastic values during a downtrend. Pay attention at this chart. The price action indicated a downward momentum with the price making lower highs. However, despite the fact that the price was making lower highs, the stochastic oscillator recorded higher highs, thus forming a hidden divergence. As you can observe, several bearish hidden divergences occurred during this period, signaling that sellers were in strong positions to enter the market. The trick is to determine the main trend and only take positions in the direction of the trend. So don't chase all the divergences that occur on the chart. Go for the ones with a higher probability, the ones in the direction of the main trend. Another way in which traders use the stochastic oscillator is to take signals when the indicator crosses the 50 level. When stochastic indicator crosses above the 50 level, this signals buying pressure. When stochastic indicator crosses below the 50 level, this signals selling pressure. This method is not used often by traders. I would say that this is an underrated method of trading with a stochastic indicator. Like I said before, the big problem is that many traders see the stochastic indicator mainly as an overbought and oversold indicator. Instead of thinking in terms of buying pressure and selling pressure, their first impulse is to seek for overbought and oversold areas. That's why a smarter way is to look for trend strength and continuation movements. A 50 level crossover of the stochastic indicator could be a solution, but only in combination with other tools. By combining it with other tools, you avoid getting beaten by the market because after all, stochastic is a lagging oscillator. As always, if you learned something new, make sure you subscribe, click the notification icon, and leave us a like to show your support. Until next time.